Good afternoon, everyone, and welcome to our Insights webinar. Today, we're tackling a topic that's critical for all of us in risk management: fraud, scams, and mule accounts. These issues aren't just operational headaches, they strike at the heart of trust in our financial system. So thank you for taking time out of your busy day to join us for a very important conversation. Next slide, please. So real quick, I want to give a disclaimer that the conversation that we're having today, there are our views and not the views of FRFS or the Board of Governors. Just wanted to express that and make sure that is abundantly clear for the audience today. Next slide, please. So here's what we'll be covering today. First, we'll share insights from a survey of 360 financial institutions on fraud and payment system risk. Next, we'll look at the top trends in check fraud as well as scams, two areas that continue to evolve and challenge even the most sophisticated risk teams. Then we'll dive into findings on mule accounts, which are hidden enablers behind fraud and scams. Finally, we'll discuss practical solutions, tools and services available through FRFS that can help you mitigate these risks today while you build longer-term strategies. Our goal is to give you actionable information and context for your own risk management plans. With that, let's meet our panelists who bring decades of experience and unique perspectives to this discussion. So I'll start. My name is Trian Desluc. I'm a senior National Account Relationship Manager. I work on our National Accounts team. I've worked for the Federal Reserve Bank now 12 years, going on 13 years this year. Our team works with a portfolio of the largest financial institutions in the country, and we have the opportunity to see firsthand the industry challenges as well as the innovations shaping the risk management landscape. It's my pleasure to be here with you today, and I would like to pass it over to Stacy to give her an opportunity to introduce herself.
Thank you. I'm Stacy Shatoff. I'm an Assistant Vice President of Secure Payments here within Payment System Improvement. My focus is advancing payment security and fraud mitigation through research, outreach, and collaboration. My team and I work closely with the industry partners to develop strategies that help strengthen the entire ecosystem. And with that, I will pass it over to Della.
Thanks, Stacy. My name is Della Tate, and I'm a program director in the Federal Reserve Financial Services Product Management team. And I bring over 35 years of payment industry experience, 30 of those with the Fed this year, to developing products that help manage risk. So my role is translating customer needs into practical solutions. With that, I'm going to hand it over to Rob.
Thank you. My name is Rob Williams. I've spent about 25 years in FRFS across product management, marketing, and analytics. I've managed this survey for the past few years, and I'm excited to share what we've learned from your peers about fraud, scams, and mule accounts, and also hear your thoughts in polling. So let's jump in. Let's ground ourselves in what your peers are saying. We asked financial institutions about their biggest fraud challenges, and three themes emerged. First, industry cooperation is critical. Fraudsters exploit the gaps between institutions. Mule accounts don't exist in isolation. They're part of networks spanning multiple banks. When we don't share intelligence, we fight blind. Second, social media monitoring matters. Scams targeting your customers and brand often start there. A single viral post can quickly damage trust. Do you know how your organization is being represented on social media? Are you aware of active scam schemes in your area? Third, agility wins. Fraud evolves faster than any vendor roadmap. The institutions minimizing losses are the ones layering solutions and adapting quickly with the tools they already have today. These aren't just verbatims, they're calls to action. Keep these themes in mind as we move forward: cooperation, vigilance, and agility. Now let's talk about check fraud, a risk that refuses to go away. Our survey asked institutions to characterize their experience. Is it declining, persistent, or increasing? The results show a challenging trend. For many, check fraud is persistent, and for some, it's getting worse. Where does it happen? Primarily in branches, at ATMs, and through remote deposit capture. Check fraud often funds mule accounts, stolen checks, washed or forged are favorite tools. Given the paper nature of checks, this type of fraud is often localized. Legitimate customers may be deceived into depositing these checks. Local criminals may be compensated for going into a branch or ATM and depositing them. While the approaches taken to create the bad checks can vary, the driver for quick funds is often the motive. This rush to get paid can cause the thief or counterfeiter to get sloppy, forgetting details like duplicating check numbers on a counterfeit check. Looking at number 1 on the slide, counterfeit checks remain a low-cost, commonly used tactic for fraudsters, especially when they're targeting local banks. 94% of FIs experience stolen bank checks at a fraud event. As you're monitoring local mail theft, stolen checks often come from compromised mail. If you're not plugged into that information, you're missing an early warning sign. Number 2 on our slide shows the prevalence and increasing pressure on FIs, with 83% of organizations experiencing washing and 90% experiencing payee forgery. Roughly a quarter of FIs said it was getting worse. Many fraudulent deposits come from account holders who've been deceived or pressured, not just criminal mules. That means your frontline staff needs to know the signs. If your institution struggles to identify mule accounts, that's a red flag. It suggests that you also may be vulnerable to broader fraud attacks. Watch out for stolen checks used to open new accounts in the name of businesses that were stolen from. Number 3 shows 72% of FIs experiencing check fraud at new account opening, with 11% saying it's getting worse. If your account opening procedures are not designed to capture this issue, you could be onboarding fraud right through the front door. Bottom line is track this activity, understand its sources. If you're not doing that, you're setting your organization up for bigger losses in the future. Scams are in many ways the most insidious risk we face. They attack trust, the very foundation of our banking system. When trust erodes, everything else gets harder. Our survey found that 69% of institutions are experiencing relationship and trust scams, and 29% said it was getting worse. These include romance scams, which are devastating, not just financially, but emotionally. Victims often fall under the powerful spell. Has your organization taken steps to educate account holders about these risks? Do you have policies on how to handle situations when you suspect a customer is being victimized? Bank impostor scams are another growing threat, with 58% of FIs experiencing them and 15% saying they're getting worse. These scams are a direct attack on your brand. Fraudsters pose as your institution, tricking customers into handing over credentials or funds. This is why monitoring social media and educating customers isn't just good practice, it's essential. Then there are family and friend scams and business imposter scams. Both are on the rise, with roughly 70% of FIs experiencing them and more than 10% saying it's increasing. Business imposter scams in particular strike at the heart of your most profitable relationships. They are often business email compromise and can lead to significant losses. So what can you do? Train your frontline staff to spot red flags. These scams aren't just crimes, they're breaches of trust, and trust is what keeps our industry running. Now let's turn to mule accounts, the hidden infrastructure behind so much fraud and scam activity. Our surveys asked institutions about their experience with mule accounts, where they originate, how they are discovered, and what happens after detection. Here's what we learned. 53% of FIs experience mule accounts being opened in branches. That's still the dominant channel, but virtual openings are growing. 9% of institutions flag this as a rising threat. 67% of FIs experience mule accounts that involve legitimate customers who became mules. This is critical. It's not just synthetic identities or criminal enterprises. It's real people, often coerced or deceived. Synthetic and criminal enterprise accounts are increasing, adding complexity to detection. When it comes to prevention, 76% of institutions rely on manual review at account opening. While 41% use some automation, manual review is resource intensive. Discovery is another challenge. 52% of institutions were alerted by another FI, which underscores the importance of industry cooperation and can impact your reputation with other FIs in the industry. 51% only identified Mule accounts after experiencing a loss, which of course is too late. And what happens after detection? 58% of FIs suspend accounts for review before closing. 34% leave accounts open, but file a SAR report. In too many cases, funds are already gone. So what does that mean for you? It means Mule accounts aren't just a fraud problem, they're a network problem. They strive in the gaps between institutions. If we don't close these gaps, our industry will continue to see increasing losses. Ask yourself, how quickly can your institution detect a Mule account? How often do you reach out to other organizations when fraud or scams is apparent? And do you have escalation paths that move faster than the fraudsters? Speed is everything here. With that quick summary of some of the survey responses, let me turn the podium over to Della.
Thank you, Rob. All right, so we're going to shift gears and talk about some solutions and tools. The Federal Reserve sits at the network intersection of much of the payment activity in the US. So that gives us a unique vantage point and the ability to offer tools that require minimal technical integration. So most of the services we'll discuss today are available now, and many of you are already using them, or they only require some minimal paperwork or self-enablement to activate. These targeted solutions close critical gaps while you work on longer-term strategies. So think of them as tactical tools, quick wins that help you manage risk today while you build for tomorrow. As Rob pointed out, check fraud is hitting our industry hard, and Mule accounts are making it worse. So one way to fight back is with Fed Detect duplicate check notification. And that is a service that is available at no charge to all of our check customers. And here's how it works. It gives the banks of first deposit early notice of potential duplicate checks processed by the Federal Reserve banks. So this report covers both commercial, and by that we mean both business and consumer checks, and treasury checks deposited both by your institution or another bank on the current day or within a specific historic date range. Notices arrive via encrypted email, and they can supplement your own research. So why does this matter? Because fraudsters often reuse checks, especially when they're working through mules. They know the check clearing system is fragmented, and Fed Detect helps you catch those duplicates before funds leave in some cases. Mail theft often targets many of your core customers, small and mid-sized businesses. Next slide. Next, we're going to talk about the exception resolution service. If you've ever tried to resolve an ACH or FedNow dispute with another financial institution, you know how painful it can be. Faxes, phone calls, emails, and weeks of waiting. ERS can help change that. ERS provides a secure environment for FI to FI dispute resolution, similar to long trusted check adjustment services, but without the associated settlement. You can manage exception cases through Fedline Web or Fedline Advantage, and even set up file automation now through Fedline Direct. Exceptions include disputes, notifications, questions, or requests for additional information. So why is this important for fraud and mule mitigation? Because speed matters. The faster we resolve disputes, the faster we identify mule accounts and stop scams. ERS helps eliminate many labor-intensive processes, including reducing resolution time from weeks to days, and sometimes even hours. Faster resolution isn't just operational efficiency, it's customer satisfaction, because when account holders see you resolve issues quickly, It builds that trust. So let's pause on products for just a moment and look at the industry rules that are shaping how we manage fraud and Mule activity. Specifically, Notch's evolving fraud monitoring requirements and the new ACH credit monitoring expectations on the RDFI side. Notch recognizes the very real impact that Mule accounts have on our ecosystem and the importance of financial institutions proactively working to limit both the theft of funds and the use of inbound credits to concentrate those funds in Mule accounts. So at a high level, the intent is twofold. First, fraud monitoring to constrain the mechanisms that steal funds. And second, RDFI ACH credit monitoring to spot where stolen funds are landing. In other words, to detect those Mule activities earlier and act faster. Compliance preparation doesn't have to be a big bang transformation. Treat it as a layered approach. Measure, pilot, codify, and scale, using tools you already have access to, and the operational improvements will follow. Let's turn that preparation into greater visibility with FedACH anomaly notification, and this is part of our FedDetect suite of services. Think of this as your early warning radar for ACH activity. It identifies atypical activity for the current day using baselines from your institution's own historical patterns and comparisons to industry rules. So you're able to better focus those limited resources on areas that require more attention. Operationally, the service delivers timely notifications when anomalies are detected. That gives your team the chance to investigate and adjust and interdict before those outliers become losses. So a few of the use cases that are currently available, again, this service is at no additional charge to FedACH customers, are notifications of change, which monitors when your institution is receiving the same NOC more than once outside of NACHA designated change timeframes. And this is likely evidence that one of your originators hasn't made the required updates. And that creates a source of repeat operational friction and potentially subjects your financial institution to NACHA fines. We also have same-day debit large dollar variance, which provides insights into your Fed account when unusually high dollar debit batches settle in the final same-day window, and they likely require funding adjustments. This helps you avoid overdraft situations, which is a small change that can prevent big headaches. We also have micro-entry forward and micro-entry return monitoring as part of these complementary use cases. And that tracks the velocity of micro-entries used for account verification. Sudden changes in those can sometimes indicate fraud pressure or misuse at the originator. Now, we are in the process of developing new use cases to more directly address the NACHA 2026 rule changes. And those will include originator returns that identify spikes within a short period of time of unauthorized or invalid debit return activity that's happening connected to one of your originators. We're also going to look at corporate credits to consumer accounts so that the RDFI can be notified of high dollar CCD credits being sent to accounts that have historically predominantly been consumer SEC code receivers. And that could be an indicator of vendor impersonation. We're going to look at atypical high dollar credit transactions to consumer accounts so that the RDFI will be alerted if a high dollar credit transaction is received that's atypical for that account. And that may be an indicator of some of this money mule activity. And finally, we're going to look at unauthorized returns from a receiver that is really looking for spikes within a short period of time, where you might have a receiver who is abusing that unauthorized returns, and that might be an indicator that there is some first-party fraud activity happening. So anomaly detection operationalizes your NACHA preparation. It puts data, thresholds, and alerts into the hands of the team on the day that the risk materializes. Inbound ACH credits are a primary route for Mule networks to redistribute and obscure stolen funds. The FedACH Risk RDFI Alert Service has been around for some time, but it's built to give you near real-time visibility into those flows so that you can act before funds disappear. And here's how it works. You define file, batch, and entry-level alert criteria using a combination of requirements tailored to your risk posture. The service then compares each outbound file and the batches it contains against your criteria and sends email alerts to whoever you've designated for contacts. And they receive those alerts the moment a threshold is exceeded, near simultaneously with that file release by FedACH. So even if you leverage a processor that delivers files later in the day, you still receive those RDFI alerts at release, which buys your team some time to investigate. For entry-level criteria, the service compares a designated receiver's entry at the close of the processing day, and they'll look for conditions exceeding thresholds that will generate automatic email notifications that you could potentially send straight to the account holder contacts. You can get a scan result screen in Fedline to drill down, view details, and when appropriate, even derive a return from the same workflow. So let's translate that into outcomes. Compliance and risk management. Reinforce your overall risk strategy and leverage historical reporting to address audit and compliance questions. Operational efficiencies. Gain time for research and action with alerts that arrive throughout the day. Use them to trigger due diligence on conditions like IAT entries or unusually large batches. Funds management. Help your CFO and Treasury team guard the institution's financial position and Fed account by surfacing late day dynamics, alerts on those high dollar batches and sudden balance shifts, and scenarios that could drive last minute returns. So consider a common pattern where a spike in medium value credits hit a cluster of newly active receivers late in the day. With FedACH anomaly notification and RDFI alert configured, you'll see that spike, investigate the receivers, check linkages to microentry velocity or recent descriptor anomalies, and if warranted, interdict or return entries before settlement risk compounds. That's real-time defense against Mule operations built on credit rails. To round out the toolkit, the FedACH Risk Origination Monitoring Service gives ODFIs granular control over forward batches. Regardless of the network entry point or your ACH software, you can make origination risk management part of normal operations. At its core, you set cumulative debit and credit caps, processing limits by RTN and or company IDs. You can monitor accumulated totals over a single day or across multiple processing days and receive an email notification when caps are exceeded. The service can automatically release pending batches before the last same day deadline using default options, and you can set end of day defaults to release or reject pending batches in extraordinary circumstances. You also get monitoring reports for governance and oversight. And practically that means if an originator's debit posture starts to outpace expected behavior late in the day, your caps will pend, and if appropriate, you can reject the batch, preventing unexpected exposure from sliding into settlement. For deeper background, you can review the product sheets and the FAQs, and if you're ready to explore activation or want to review your current services, please contact us. We'll walk you through options aligned to your customer profiles and same-day windows. And with that, I'm going to hand it over to Stacy.
Stella. So as we know, fraud and Mule activity don't respect boundaries. They exploit the gaps between institutions. That's why collaboration is so critical. Our outreach strategy focuses on building stronger connections across the ecosystem. Financial institutions, service providers, and industry associations, to name a few. We're expanding intelligence sharing networks so alerts move faster than the fraudsters. For example, when one bank detects a Mule pattern, others should know about it within hours, not within weeks. We're also hosting quarterly forums and working groups to surface emerging threats and share practical solutions. These sessions aren't just presentations, they're interactive exchanges where institutions learn from each other's success and failures. If you're not engaged in these conversations yet, now is the time. Collaboration isn't optional anymore. It's a frontline defense. Ask yourself, how quickly can your institution share and act on fraud alerts? If the answer isn't immediately, we can help you close that gap. So as we've heard, check fraud remains a persistent threat, even as check volumes decline. Its impact can be significant: financial losses, operational disruption, and erosion of customer trust. Fraud can succeed in part due to the lack of awareness. That's why education is a strategic lever in your risk framework. The Federal Reserve developed the Check Fraud Mitigation Toolkit to help industry detect and mitigate this type of fraud. This resource provides downloadable documents, educational videos, and interactive test your knowledge pieces. It offers 3 easy-to-navigate modules that focus on prevalent types of check fraud, the methods criminals are using to perpetrate it, and how check fraud can be prevented, detected, and mitigated. The toolkit emphasizes proactive communication, training frontline teams to spot potential red flags, and equipping customers with timely, clear information. Focused efforts can reduce fraud's financial and operational toll, and it can also strengthen trust across institutions, businesses, and customers. Together, education and awareness create resilience. Explore the toolkit and make fraud prevention a shared responsibility. As we also know, scams are evolving rapidly, costing consumers and businesses billions of dollars each year. Despite widespread awareness efforts, many still believe it won't happen to me. That mindset makes education so critical. To support the industry, the Federal Reserve developed the Scam Mitigation Toolkit. This resource contains 6 modules that focus on fundamentals of scams, including an industry-recommended definition of the term scam, common types of scams, and how and why they often successfully defraud individuals and organizations. This toolkit also contains downloadable resources, educational videos, as well as interactive test your knowledge sections where you can see if you can spot the scam or classify the fraud event correctly. By educating staff and customers, organizations can help reduce risk and strengthen trust. Explore the toolkit and make scam prevention a shared responsibility. Synthetic identity fraud is one of the fastest growing threats in the payment industry and beyond. It occurs when criminals create fictitious identities by combining real and fake information, enabling them to open accounts, access credit, and exploit multiple sectors all at the same time. The impact is staggering. U.S. financial institutions faced an estimated $20 billion in loss exposure in 2020 alone due to synthetic identity activity. So why is this issue so critical? Synthetic identities often go undetected by traditional fraud models, as we're not typically looking for someone who isn't real. These identities can infiltrate financial, healthcare, and government systems simultaneously, causing widespread harm. While financial institutions bear the initial cost, individuals can also suffer long-term consequences should their information be used. To address this challenge, the Federal Reserve developed the Synthetic Identity Fraud Toolkit, a resource designed to promote education, awareness, and collaboration across the industry. It offers practical strategies and informative materials for financial institutions, businesses, and consumers. As fraud tactics evolve, new resources continue to be added. Combating synthetic identity fraud requires vigilance and is a shared responsibility. Explore the toolkit and join the effort to build safer, more resilient payment systems. Now let's look at the scam classifier model. This tool was designed to help institutions better understand scam patterns and improve post-event analysis. Within the industry, this level of classification can help institutions speak the same language, understand industry-level trends, and establish benchmarks for comparisons. This model isn't about real-time interdiction. Its strength lies in benchmarking and trend analysis. By applying scam classifier to historical data, institutions can identify when scam typologies are most prevalent and how they evolve over time, as well as where vulnerabilities may exist. So why does this matter? Because benchmarking gives you context. It helps you compare your institution's exposure against industry norms and spot outliers that may indicate emerging risks. Post-transaction analysis also informs training opportunities and control enhancements, so you're not just reacting to losses, but you're also learning from them. In short, Scam Classifier is a diagnostic tool. It turns raw data into insights you can use to refine strategies, strengthen education efforts, and improve fraud governance. If you'd like to explore how to incorporate this model into your risk review process, we can share examples and best practices. Benchmarking helps here too. When you compare education efforts against industry norms, you can identify gaps and prioritize improvements. The outcome? More insights, stronger customer trust, and a workforce that know how to act quickly when something looks wrong. And with that, I will transfer to Triandos.
So as we've seen today, fraud, scams, and mule accounts aren't isolated challenges. They're interconnected risks that demand coordinated action. From survey insights to practical tools, the message is clear. Vigilance, agility, and collaboration are our strongest defenses. Whether it's leveraging Fed services, tightening controls, or educating customers, every step we take closes gaps that fraudsters exploit. The industry's success depends on speed and shared intelligence, and together we can turn these strategies into measurable results. With that foundation in mind, let's move to our conclusion and outline the key takeaways you can act on. As financial institutions reflect on their customer experience, one truth stands out. Fraud risk management isn't just about stopping losses. It's about protecting trust and preserving confidence in the financial system. Today, we've explored critical gaps and practical solutions that can help you close those vulnerabilities and strengthen your fraud posture. Let's start with check fraud. Bad actors exploit latency and fragmented clearing networks, taking advantage of the lack of unified data sources for deposit validation. Once they have a check, or even just a check image, they can alter, replicate, or circulate it across multiple institutions. FRFS leverages its unique role with the U.S. Treasury and its large market share of commercial checks to provide visibility into duplicate and altered items. This means you can intercept fraud before funds disappear and, most importantly, protect your customers from cascading losses. Next, consider ACH and Mule accounts. The explosive growth of ACH and same-day ACH has created new exposure points. Not just evolving rules now make RDFIs more accountable for monitoring inbound credits, and FRFS solutions like RDFI Alert and anomaly detection give you near real-time visibility into suspicious flows. These tools help you act before Mule accounts redistribute stolen funds, closing a gap that fraudsters have exploited for years. Then there's the ISO 20022 transition. As legacy FAME data meets ISO structures, reporting and analytics can't fall behind. Fed Transaction Analyzer bridges that gap, ensuring continuity and compliance without costly overhauls, so your fraud and risk teams maintain the insights they need. And let's not forget about instant payments. FedNow introduces speed, and with speed comes risk. Features like account activity thresholds and layered controls help you manage fraud in real time without slowing innovation. Finally, after fraud occurs, speed matters in dispute resolution. FRFS Exception Resolution Service reduces resolution time by up to 8 times turning a potential customer loss into a trust building moment. The takeaway: fraudsters thrive in the gaps. FRFS solutions help you close those gaps with speed, intelligence, and collaboration. Together, we can turn risk into resilience and resilience into a competitive advantage. To the audience, I want to thank you so much for, again, taking time out of your busy schedules to join us for this very important conversation. We know fraud is top of mind for a lot of our customers out there, and we want to continue to do our part as your partner to kind of help you fight against that major risk and help mitigate and provide services that's going to help you fight against fraud. So please, I know Della has mentioned it, Rob, as well as Stacy, reach out to your relationship managers and inquire how our service can help you in this ongoing battle. So again, appreciate your time. Hopefully this was beneficial. It's always a pleasure to get the opportunity to present what we're doing from an FRFS perspective in the industry. So I hope everyone have a wonderful day. And again, thank you for your time.